So Jamil, let's start with the biggest news this week. China announced that its economy grew by 2.3% in 2020. Behind that is the retail sales number, which shrunk by 3.9% in 2020. China is, of course, the world's second biggest economy. How did investors react to these numbers?
Investors reacted reasonably positively to these numbers because I think there was a lot of interesting perspectives we could take. You just pointed out that retail sales fell, and that's true. It was something like the first fall in retail sales for close to 4 decades. But at the same point, similar economies are going through the worst economic contractions like the UK in close to 300 years. And I think that behind the numbers, you saw that China's GDP in the final quarter of 2020 increased to just above 6%, which largely showed that the Chinese economy from Q1 to Q3 went through a massive turnaround, that in Q4 things pretty much got back to normal, not to the exact same trends and momentum that we thought before the pandemic, but things definitely got better. And I think that China's share to global GDP increased by 1% just during the pandemic. China's GDP now accounts for something like 16% of world global economic momentum and growth, whereas before the pandemic it was 15%. That might not sound like a lot, but when you consider the pandemic's only been 1 year and China's legacy has already changed. And the final perspective that I saw that investors also thought was pretty interesting was that the Chinese economy actually benefited from more economies going through the pandemic, the infection outbreaks and the return of lockdowns, because you saw a lot of demand for Chinese goods and Chinese exports, most likely because of other economies having their own supply and productivity issues. So more economies and businesses look towards Chinese goods.
But looking at the numbers, did investors zoom into specific sectors immediately after the announcement? What was the reaction immediately after the announcement?
There wasn't any specific sectors that you could say that investors looked towards in terms of valuation, but we saw a lot more, I would say, improved mood over the Chinese manufacturing industry, also the Chinese infrastructure spending industry too. I think that really what China will focus on in 2021 is trying to improve its own domestic economy and domestic spending, because that's where we did see a shortfall, which at least shows that domestically Chinese people as an individual economy, they did also face shortcomings through this pandemic. So that's a universal trend, of course. And I think in 2021, with lots of economies continuing to go through the lockdown, specifically in Europe and the United Kingdom, where we're in phase 3 and phase 2, phase 4 of the same lockdowns, that the China economy will continue to benefit from this situation in 2021 as well.
And tell us more about that. This lockdown. We are entering into week 2, week 3 of this lockdown. Tell us about how markets around the world are reacting to this lockdown. Are they starting to price in these lockdowns?
They are to a degree. I think it's seen as a cycle. It's like we're going round and roundabout and we're just going to the same direction anyway, despite trying to go into a different direction. Essentially, investors, I would say, they're still concerned because we're seeing a lot of deja vu and a lot of very unfortunate things are definitely getting worse before they get better, that kind of attitude and sentiment. But overall, as long as governments continue to unleash financial and economic support, and that's combined by the vaccines becoming more readily available. At the same time, central banks obviously keeping a very downbeat narrative and stance on how economic and monetary policy should be. Investors are wanting to look past that, but I do think that there is a struggle right now to see stronger market valuations. We're pretty much close to record highs, and I would struggle to see how much more upside there is to markets at the same point where the infection outbreaks, they're showing a very a fragile and a precarious picture.
And Jameel, in a few hours, the US will witness the beginning of a new era, the Biden-Harris era. Could this new era provide a certainty, or the certainty needed in 2021, the end of the trade war via Twitter, the ban on Chinese companies? Have markets already priced this in, or do you think there could be a rally because of this optimism, because of the Biden or the Biden-Harris era?
A little bit, but I still think there can be a market rally in certain sectors like Chinese technology firms, also the banking sector. Globally, there can also be some support as well, because everything comes down to Biden's approach and his inauguration speech. One thing that Biden offers that, and I'm not saying was a negative on Trump. I don't want to go political, but Biden offers a level of consistency. You know that his approach will be a narrative of the need for unity, global collaboration. Yes, there are problems, but let's try and solve these problems. Whereas the current administration's been more of about shouting on social media feeds, and it's been much more erratic on an hour-by-hour basis. So as long as Biden shows levels of consistency, there's no sugarcoating that the global world and the economy, politically, socially, and economically is going through huge structural shifts. But as long as the Biden administration shows that they want to work together and nobody should go through this alone, I think that markets and investors can look positively upon this fact.
And a $1.9 trillion stimulus package is also in the pipeline, but the vaccination program in the US is still a bit slow, and the COVID-19 cases are still on the rise. Will consumers instead focus on deleveraging when they perhaps get the $1,600 check from the the new stimulus package, and not spend as much as the investors are expecting? If they are spending, which sectors would benefit, and do you think they be spending, or do you think they be deleveraging?
This is the real interesting point regarding deleveraging and how consumers handle their money, because the United States economy, it's critically reliant on consumer spending and spending within the United States economy. Just to give you a few different statistics here, domestic spending, which basically means how much money is spent locally in the US economy, whether that's through retail sales or domestic tourism or any kind of consumer spending in restaurants, hospitality, and so on, actually equates to as much as 70% of US GDP. So the US economy, on that perspective, is more sensitive towards its own shortcomings and its own problems domestically than actually what it is to exports and what's going on in global economic momentum. Whereas you look at the global economy, and the global economy always looks towards the United States for an indicator on how its own surroundings will change on a world basis. So I think for the US economy, the stimulus package, it is essential that something's done to try and encourage domestic spending, consumer spending, obviously in a responsible way, for the US economy and its momentum to improve. And then that in turn will lead to the global economy looking a bit more positive. But things are certainly fragile in the United States. We saw 1 million close to initial jobless claims on a weekly basis just last week. That means that the most unemployed benefits applications on a weekly basis since March of 2020, just 1 week ago. And on a monthly basis, the United States has even contracted jobs for the first time since roughly April 2020. So that shows that the domestic economy in the United States, not only does it need support, it needs a vaccine, it needs its own support machine. And that's why Biden is going big and going hard on this trillion stimulus package. Just a final thing on the package is 1.9 trillion plus the 1.9 trillion that was offered earlier in 2020 from the Trump administration, plus some additional measures in between. And that shows that the amount of money the United States has spent on its economy in result of this pandemic is coming close to 4 trillion US dollars. That's how severe of an impact it has had.
And on that note, do you think the Dow Jones could perhaps touch the 31,000 mark?
Actually, I'm a little bit neutral on this specific call because we do not know how the Biden administration is going to handle the technology giants, because the Democratic lawmakers before the election, this wasn't talked about so much because the election and the pandemic was such a big deal, but Democratic lawmakers actually said and were very strict that technology giants, specifically the Facebooks, the Apples, the Amazons, they need to be looked at in a scrutiny way very closely for what they thought is monopoly power. Basically, they were having too much control over the whole technology sector. Now, that can be debated due to different factors, but nonetheless, that means the Democrats are looking at them very closely. And I do not think one of the initial things on the agenda for the Democrats to identify and rectify will necessarily be the power of technology firms, because of really the pandemic, the economy, international relations. There's so many things that are higher on the agenda. But because we do know that the Democrats have a very tough stance on this particular issue, which was tougher than the Republicans, and that's been exacerbated by the Democrats also include controlling now the Senate and the House. The Democrats had more political influence and power in the US political system for many years. And because of this, I would be more neutral and cautious towards the technology stocks. Yes, stay from home stocks can return. The Netflixes and your streaming devices are going to remain very, very close friends to us all during lockdown. but we still have a lot of scrutiny on technology giants, specifically social media applications.
And will the Biden-Harris optimism, do you think it will spill over into oil? How will oil fare this week?
So we're seeing a little bit of a pullback in oil today. That's not a big surprise because we've seen the IEA, which is the International Energy Agency, have cut demand for oil in 2021. Again, not a big surprise because so many economies are going back through a lockdown cycle. Nonetheless, as long as oil price can remain above $50, the outlook is still more positive than negative. But I do think that we might have seen a big rally in oil price over the past couple of weeks and months. We're up about 7 to 9% overall. And I do think that $50 remains the magic number to watch. We might hit 55, 57 and go towards $60 later in 2021. But I think that we are due a little bit of a correction over the near term. At the moment, we're trading about $52 as we make this interview recorded, and we might go back towards 50. Again, if we don't fall lower than 50, the oil outlook remains okay.
And Jameel, talk about Ringgit, or tell us about Ringgit and what movement have you seen so far? The government announced a 15 billion Ringgit stimulus plan yesterday. Did that affect Ringgit at all?
It has impacted the Ringgit. It's more of an impact for the Malaysian economy, specifically Malaysian employment. We know that up to 1 million jobs have been lost in the Malaysian economy during this pandemic. So the economic stimulus package is more about improving the real economy than market valuations. Nonetheless, it does have a positive impact on the stock market and investors because more cash is available in the system. I think that the Malaysian ringgit right now, we're still pretty close to 4 against the US dollar. I'm still hopeful that the ringgit can improve below 4 later in 2021, but we've seen a little bit of recovery in the US dollar in the early stages of 2021 as well. I do think that's a short-term impact, but we could see the ringgit go back towards 408, 409 over the near term. Again, we have a key interest rate decision coming out in the next couple of days as well when it comes to Malaysian economy and weeks. And I think that as long as the Central Bank of Malaysia issues at least an honest assessment that the global economy is going through another troubling period, there's no denying that, and that the Malaysian economy is also going through its own domestic issues because of the return on lockdown measures like elsewhere in the world. I do think there's more of a likelihood that the Bank NAGA will cut interest rates than perhaps is being priced in, and depending on what decisions or what narratives they provide as well in their assessment, that could have a short-term impact on the ringgit too.
On that note, we thank you very much, Jameel, for joining us.
Thank you for having me.
Thank you.